You've probably heard the term value trap thrown around a lot. That's when you purchase a stock thinking you're getting some sort of a bargain. Well, there's no free lunch. Today we're going to talk about one of the most common mistakes we see investors make. No, not investing in ICOs, NFTs, pre-revenue companies, over-the-counter junk, or any other obvious rubbish. We're talking about the silent killer, value traps. So what's a value trap? Well, Aswath Damodaran has put together 3 quantitative screens that are typically used to find quote-unquote cheap stocks. So you have book value screens, earnings multiple screens, and cash yield screens. I think the latter 2 here are most frequently used by investors. So let's briefly look at valuation. So for the 2 strategies we run here at Nanalyze, disruptive growth stocks. So revenue growth is a proxy for market share being captured. So that's one of the most important metrics we look at. We expect to see at least 22% growth. If public SaaS companies in 2023 could achieve that on average, then that's realistic to expect. A simple valuation ratio helps us not overpay. We simply take market cap and divide that by annualized revenues. We use annualized based on the last quarter so that it's more sensitive. When it comes to dividend growth stocks, when we create a portfolio, we'll start out by buying equal amounts across all the positions, and then we adjust those contributions to weight our constituents evenly. So it sort of balances itself out, because if you're building a dividend growth portfolio over a sufficient period of time, let's say several decades, then trying to sit there, I suppose if you had the time and set some rules, you could use valuations, but trying to sit there and calculate valuations all the time will result in a lot of market timing risk when we just can use dollar cost averaging and avoid that. This formula that we have for Quantigence, our dividend growth strategy, looks at a number of factors, one of those being yield, and we actually cap yield to avoid yield traps. That's what we're focused on today. So what we've observed is this: very attractive yields, let's say upwards of 6%, represent a serious concern, and these attractive yields should be measured relative to what they were previously. So one example would be VFC, and here you can see some very telling charts along the top there. That's the stock price over time. So what typically happens is when a stock price falls and the dividend stays the same, yield increases. You're getting more dividend for the amount of money you're paying for the stock. But if the stock price plummets, as you see here, and yield plummets as well, that means that the dividend was cut. And indeed, as VFC's dividend started approaching 6%, we became quite concerned as shareholders of VFC, and we published this piece, VF Corp's attractive 6% yield. If you're not familiar with VF Corporation, they operate a portfolio of businesses, one being North Face, this classic picture taken from the Tiger Leaping Gorge in China, shows a fake North Face that I bought. And when we were looking at VFC, this is from that presentation, we noted that in the past, their dividend yield had spiked quite high. So you see here, close to 5%. That green arrow is pointing to the 2009 financial crisis, when all yields across the board would have increased because share prices were decreasing across the board. Now look at that red arrow. That's pointing to the concern that we had. Why is VFC's yield spiking so dramatically? And to put this into perspective, we also put up J&J's yield over time. And what we've observed is that yield tends to provide a support level for stocks. So for example, when J&J hits a yield upwards of 3.5%, there you see that's attractive to investors, and there's a support level. They step in to purchase that so they don't let yield get quite high. That's because the market has confidence in that dividend. Now, when yield spikes dramatically, it's a red flag because it hints that the market doesn't have confidence anymore in that dividend. So this slide taken from that presentation turned out to be quite telling. We simply looked at their updated guidance here, the cash flow from operations that they were expecting, their CapEx, and we added those 2 together, you see along the bottom, and they had a deficit there of around $122 million. What ended up happening is that they cut their dividend, and as soon as that happened, we sold the stock immediately. When we're holding a dividend growth firm, that's the only reason that we would sell one, is if they stop increasing their dividend. And what came along with our concerns was this note from Moody's. It says Moody's changes VF Corp's outlook to negative. Perhaps that should have been a tell. You see here they reference a lot of different things. You can pause this and read through the list, but higher than expected debt levels stood out. And what we want to look at is how we can spot yield traps. Now, before I get into that, a word from Wyatt for our premium subscribers.
We're super excited to announce that we're launching a new tool. It's the Quantigence Q-Score Calculator. So this will be embedded in our website, and it will allow you to rank and select your own dividend constituents to build your own dividend portfolio. So our premium annual subscribers are going to have access to this tool along with our 2 existing reports, our core Quantigence portfolio and our international dividend champions report. Thank you guys so much for your financial support, and please stay tuned.
So how can we identify dividend traps? Well, Morningstar had a good piece which looked at 3 things we should be paying attention to. Very high payout ratios. So that's something we take into account in our own Quantigence strategy. And when we look at the payout ratio, we actually penalize those above a certain percentage. High levels of debt, that's not something that we look at, but in today's presentation, it's interesting how debt really comes into play when things start becoming tight at a firm. And the difference between profits and cash, what do they say? Profits are opinion, cash is a fact, and it's absolutely true. High payout ratios, so this is from that piece, mean companies are not investing sufficiently in their own business. So we've always thought of a payout ratio as a buffer, right? So the lower your payout ratio, the bigger buffer you have, and earnings per share can actually decline, but you still have that buffer there so you can keep increasing dividends. Well, this makes another good point that if your payout ratio is too high, you're not investing in the growth of your own business, and eventually you'll start to see declining revenues. They say in some businesses, and how true is this, there can be a big difference between stated profit and the cash flowing into the business. So look at free cash flow payout ratio. We're going to look at that a little bit later. And then they talk about how firms with high debt levels may be driven to cut their dividends in tough times because they have all that debt to service. Well, one thing to note there is also debt can be used to pay a dividend or increase it, as in the case with oil companies. So if you have too much debt, it puts you into a corner there. So the second example we're going to look at is Walgreen Boots Alliance. And on the bottom there, you can see this massive spike of their dividend yield, which is accompanied by, along the top there, a massive decline in share price, which Walgreen Boots cut their dividend in half, more or less, and it's down 66% since the beginning of the year. So that's sent the yield through the roof, even with the new reduced dividend. Now, their 11% yield right now is very enticing, but here's the question: is this value or value trap? Now, I think in order to properly understand yield, we ought to try to calculate it. We've done that here. So the box on the top right there, that shows the total of their last 4 dividends divided by share price to give you a yield. Now you notice how you can see the dividend cut, right? It was 48 cents, 48 cents, 25 cents, 25 cents. Okay, so that gives them a yield of 16%. But the better way to calculate yield would be to consider that new dividend they're paying looking forward. So presuming what they call a forward-looking yield, presuming that's what they're going to pay going forward, you get a yield of 11%, which is still quite attractive. One simple question you need to try to answer here: what's the likelihood that WBA can continue paying out that 25-cent dividend going forward? Remember, if the dividend gets suspended, that can happen at any time, the yield goes to 0. You don't have a yield. So all that value you think you're getting disappears. Such a high yield, around 11%, is a huge red flag, and it typically points to the dividend not being sustainable. And here we see a note from, I believe this is Moody's, on downgrading their debt, and they cite here limited cash flow generation, large maturities in coming years. They lowered our ratings on Walgreen 2 notches. Look at this. They say that in the event of default, they expect 65% recovery for those that hold debt. That's not good at all. And they say that the firm is seeing pressure on both its pharmacy and retail segments. So lots to digest here, but it seems like a big red flag. When you look at debt, this is rather remarkable. They only have $739 million in cash on hand. Look at their free cash flow over the past trailing 12 months. It's almost minus $1 billion. So they're going to have a problem paying a dividend if they don't have free cash flow. And look at the issuance of debt and the repayment of debt. So they're robbing Peter to pay Paul. Look at the spike here on this chart of their debt over time. So going back to that comment about paying attention to debt, it's potentially very problematic. And just remember that also when you have tough times, I like this chart here. This is from Morningstar. It shows how dividend cuts in times of crisis, you see in the United States there in 2020, of the 981 payers in the U.S., 91 cut their dividends. Dividend cuts, of course, can happen at any time for distressed companies. So this is what's so great about dividend champions is these dividend kings, they've been increasing dividends for 50 or more years. That's remarkable, right? So an example of a firm that probably would have checked the boxes to be a concern was ExxonMobil. You can see here when their yield spiked to 8%, we actually added shares. And the reason we did that is because we believed that the dramatic drop in oil price because of the pandemic was temporary. And indeed it was. And this turned out to be the right decision. But it's always not so clear cut. Consider IBM. So we recently looked at them in several pieces. Their free cash flows more than cover their dividend. I think it's around 50%. So that isn't a problem. Their yield isn't at red flag levels at 3.3%, though their net debt load is quite heavy at $40 billion. Now, if we're concerned about IBM, I think a good step, or any firm, would be to look at what the ratings agencies have to say, because they, at least in the two examples we've given today, have said some very telling stuff. But we're not concerned about IBM right now. We are concerned about what's going on with Ben. So Franklin Templeton, this is a firm we happen to be holding. It's in our new money report. The dividend yield right now, and I simply went to our 30 DJI stock portfolio. I sorted on yield, and these were the top yielding firms. So I think REITs traditionally have higher yields, and of course, CVX is an oil company. They have higher yields. But Ben is spiking their yield. You can see that here. 2 points I wanted to make on this chart. First red arrow pointing to the right, that shows their special dividend. We don't include those when we calculate yield and things like that in our own strategy. But it's interesting to note, right? They had a special dividend, and then it brought that yield up for 4 quarters based on how we showed you how they calculate yield. Then it dropped back down to normal. But look at the spike there. You see how that's spiking up towards 6% or over 6%. So that's something we're going to want to look at. Stay tuned for that. Now, just some concluding thoughts. Our DGI strategy sells for one reason only, and that's a dividend stops growing. Now, Q scores decline as payout ratios increase and dividend growth stalls. So our strategy actually, and what would be an interesting next step, is to plot Q scores over time. And I've noticed that just in my own experience with our strategy, they do decline over time. Oftentimes we'll be like, why are we holding this name with such a low Q score? And then all of a sudden it runs into a problem. So that's an interesting idea there about paying attention to Q score values. Getting back to the worst mistakes investors make, I think I could think of 3 of them off the top of my head. Thinking a low share price is cheap, that's easy to navigate, but until that becomes intuitive, you haven't gotten over that. That's something that everyone falls for, myself included. It just becomes intuitive over time. Investing before revenues, that's very easy to navigate. You don't invest in companies unless they have meaningful revenues. That's saved us, I think, more money than any other rule we have. Take yield at face value. That's what we've talked about today. That's very tricky to navigate, as we've shown in the examples, and we can help with that. So Nanalyze premium annual subscribers get alerts, trade alerts sent when dividend champions run into problems. The rate at which a dividend grows is much more important than the yield. The yield is often given too much emphasis by dividend investors. And I think debt ratings, as we looked at today, a downgrade may be a leading or lagging indicator as to a company running into problems. Now, if you're interested in building your own dividend portfolio, we have a number of tools that help you do that. But this video is certainly edifying. So give that a watch next. Make sure to subscribe to our newsletter in the comment section. Thanks so much for taking the time to watch this today.